Imagine opening your investment account, business valuation, or net worth tracker and seeing this number for the first time. $1 million. You refresh the page just to make sure. You take a screenshot. Maybe you send it to one person you trust. Or maybe you tell absolutely no one. For years, this number represented success, security, freedom, and proof that you had finally made it. But then something strange happens. The following morning arrives, and your life looks almost exactly the same. You still have decisions to make. You still have bills to pay. The market can still fall. Your business can still struggle. And you still have to decide whether you can afford to stop working. A new question replaces the old one. You spent years asking, how do I make $1 million? Now, you have to ask, what is this million actually for? Before discussing what having $1 million feels like, we need to define what it means. A business producing $1 million in revenue has not necessarily made its owner a millionaire. Earning $1 million across an entire career does not mean you still possess $1 million. Owning $1 million worth of assets does not make you a millionaire if those assets came with $1 million of debt. For this video, making your first million means reaching a net worth of $1 million. Net worth is everything you own minus everything you owe. Your assets might include cash, investments, retirement accounts, property, and business ownership. Your liabilities could include mortgages, business loans, student debt, credit card balances, and other obligations. That distinction matters because $1 million net worth is usually not $1 million sitting in a bank account. Consider a fictional example. Alex has $60,000 in cash, $280,000 in ordinary investment accounts, $240,000 in retirement accounts, a home worth $600,000, and a business interest valued at $220,000. That gives Alex total assets of $1.4 million. But Alex also has a $330,000 mortgage and $70,000 in other personal and business debt. Subtract $400,000 of liabilities from $1.4 million in assets, and Alex has officially reached a net worth of $1 million. But look more closely. Only $60,000 is cash. Another $280,000 is invested and could fluctuate with the market. The home cannot pay for groceries unless Alex sells it, rents part of it, or borrows against it. The retirement money may have access restrictions or tax consequences, depending on the account and country. And the business is worth $220,000 only if that valuation is accurate. And if someone is willing to pay it, Alex is genuinely a millionaire. But Alex cannot safely spend $1 million. This is the first major surprise. Becoming a millionaire can change your balance sheet long before it changes your lifestyle. The first emotion may be excitement, but the emotion that lasts is often relief. You have room to survive a setback. You can leave a bad situation without immediately wondering how you will pay next month's expenses. You can potentially take a career risk, care for someone you love, or simply sleep better. Money creates options, and options create a form of freedom. But the milestone can also produce unexpected anxiety. When you had $10,000, losing 10% meant losing $1,000. At $1 million, a 10% decline represents $100,000. The percentage is the same. The emotional number is not. You may start checking your accounts more frequently. You may become more cautious. You may wonder whether reaching 1 million was the result of skill, luck, or temporary market conditions. Instead of worrying about how to become wealthy, you begin worrying about how to remain wealthy. Research does not support the simplistic claim that money has no relationship with happiness. A major study involving researchers Matthew Killingsworth, Daniel Kahneman, and Barbara Mellers found that emotional well-being generally continued rising with income for most participants. The flattening effect appeared primarily among the least happy group. However, that research examined income. It did not examine the psychological effect of crossing a particular net worth milestone. The sensible conclusion is not that money cannot improve your life. Money can improve your circumstances without automatically repairing your health, relationships, identity, or sense of purpose. Morgan Housel captures this contradiction in his book, The Psychology of Money. Wealth is what you don't see. The expensive car is visible. The money that was not spent on the car is invisible. The luxury holiday is visible. The emergency fund that prevented a family crisis is invisible. The enormous house is visible. The absence of a mortgage payment is invisible. This creates a social trap. After reaching $1 million, you may feel pressure to start looking like a millionaire. But spending money to prove that you are wealthy can reduce the very wealth you are trying to display. $1 million creates the most freedom when it is not required to perform for an audience. This brings us to one of the biggest questions. Does having $1 million mean you can retire? This is where the conversation becomes less glamorous. $1 million of net worth is not automatically $1 million of investable retirement assets. If a large portion is tied up in a home, business, or assets you do not intend to sell, that portion cannot directly fund your living expenses. Even if the entire million were invested, it would not necessarily produce a six-figure lifestyle. Morningstar's research for people beginning retirement in 2026 estimated a starting withdrawal rate of 3.9% for a portfolio designed to provide consistent, inflation-adjusted spending. On $1 million, that equals $39,000 during the first year, before personal taxes and investment fees. That estimate assumes a 30-year retirement, a particular portfolio composition, and a 90% probability of funds remaining at the end. It is not a promise, and it is not a universal retirement formula. Someone retiring at 35 may need the money to last much longer than 30 years. Someone with rental income, a pension, or another reliable source of income may have more flexibility. Someone willing to reduce spending after a weak market may also be able to approach withdrawals differently. The point is not that 3.9% is the perfect number. The point is that $1 million is capital. It is not an unlimited salary. And if your $1 million net worth includes your home and business, even that $39,000 illustration may not apply. So what should happen after reaching $1 million? Reaching the milestone does not require an immediate reinvention of your life. In fact, the first sensible decision may be to make no dramatic decision at all. Do not immediately quit your job, purchase a house, lend money to everyone you know, or move your entire portfolio into the newest investment trend. Give the milestone time to become normal. Then perform a financial reality check. Start by confirming the number. List every asset, every debt, and the method used to value each item. Separate liquid assets from illiquid ones. Separate personal assets from business assets. Identify potential taxes and transaction costs. A private business valued at $500,000 is not equivalent to $500,000 in cash. A house valued by an online estimate may sell for more or less. An investment with a large gain may create a tax bill when sold. Next, decide how much liquidity you need. The correct amount depends on your employment stability, business obligations, dependents, insurance, expenses, and personal tolerance for risk. The objective is not to keep the entire million in cash. The objective is to avoid being forced to sell long-term assets at a terrible time because of a short-term emergency. You should also examine concentration. Many first-generation millionaires reach the milestone through one dominant asset. It might be a business, a property, shares in their employer, or one highly successful investment. That concentration may be what created the wealth. It can also be what destroys it. Diversification means spreading money across different investments so that your entire financial future does not depend on one company, property, industry, or economic outcome. Diversification cannot remove every risk, but it can reduce the damage caused by one failure. At $1 million, percentages that once looked harmless also become expensive. A 1% annual fee on $1 million portfolio begins at $10,000 per year. But the larger cost is not only the fee. It is the future growth that money could have earned. The United States Securities and Exchange Commission provides a hypothetical example involving $100,000 growing at 4% annually for 20 years. With a 0.25% annual fee, the example ends at approximately $208,000. With a 1% fee, it ends at approximately $179,000. That is a difference of about $29,000 on a $100,000 starting portfolio. Scale the same hypothetical assumptions to $1 million, and the difference becomes approximately $290,000. This does not mean the cheapest option is automatically the best. It means you should understand what you are paying, what service you receive, and whether an advisor or investment product has financial incentives that conflict with yours. At $1 million, controlling costs and avoiding major mistakes can matter as much as discovering the next spectacular investment. Once the number is protected, the harder question begins. What do you want the money to do? You might divide its purpose into 4 categories: security, freedom, growth, and enjoyment. Security is the amount that protects your basic life from emergencies and economic shocks. Freedom is the portion that gives you more control over your time, work, and major life decisions. Growth is money intended to remain invested for the future. And enjoyment is money you can deliberately spend, share, or give away without damaging the first 3 categories. These categories do not require equal percentages. Their purpose is to stop every dollar from being assigned the same job. Money reserved for next year's expenses should not necessarily take the same risk as money intended for 30 years from now. At the same time, money becomes difficult to enjoy when you have never defined how much you are allowed to spend. The goal is not to preserve every dollar forever. The goal is to spend intentionally enough that today's enjoyment does not become tomorrow's regret. Making your first million probably will not feel like the final scene of a movie. There may be no dramatic celebration, no immediate transformation, no moment when every problem disappears. What changes is quieter. A surprise expense becomes an inconvenience instead of a catastrophe. A bad job becomes something you may be able to leave. A family emergency becomes something you may be able to handle. Time becomes something you can potentially reclaim. And saying no becomes easier. The greatest value of the first million is not that it allows you to buy everything. It is that, if managed carefully, it can reduce the number of decisions you are forced to make from fear. But it only creates that freedom if you resist the pressure to prove that you have it. The first million is not the finish line. It is the moment when the question changes from how much can I accumulate to how do I turn what I have accumulated into a life I actually want. So, you made your first million. Now what? Protect it. Give it a purpose and use it well. If you reached $1 million tomorrow, what would genuinely change? Would you keep working? Invest more? Buy back your time? Or finally allow yourself to enjoy some of it? Share your answer below. This video is for educational purposes and does not provide personal, financial, tax, or legal advice. Financial rules vary by country, account type, and individual circumstances.